GetCrack. Wake up, motherfucker.
Yo, what's up? It's April 10th, 2025. Here, let's look at the charts right now. So, yesterday we had a big pump. I was about to go on stream yesterday, and then like 30 minutes before, and then I saw like the candle start moving like crazy. I said, "Uh-oh. Uh-oh. Trump said something. Trump said something." And I had to set up all my sell orders because I was long yesterday. I didn't expect anything to happen yesterday, honestly. I thought it was going to be a boring day. So that was a surprise. If I knew it was going to jump up 12% on the NASDAQ and 10% on the SPY, I would have bet more. But the last big bets I made were like from last week into let's see, I went from Thursday all the way into Friday, but that was it. Then I was done. Closed the shorts on Monday, and I was just waiting. Okay, Tuesday did some shorting there. Like you can see, like it jumped up, popped up right to this resistance area at 521. It rolled back down the hill, and I said, all right, close the short at the end of the day. And then the next day, oh, look, it's trying to fight above this support area at 495 in the SPY. I said, all right, well, let's see what happens in the next couple hours. It kept holding on into lunch. I said, all right, maybe I'll go long. I wasn't super confident, but I said, might as well go long. Because if you look on the 13-minute, 10-minute type charts, you could see like it was just building up energy. And the only news that was going to come out was Powell was going to talk. Okay. I mean, not talk, but they were going to release the meeting minutes from the last meeting. Probably nothing burger. It's old news, stale news. The other thing was there was a bond auction. Okay. There was going to be a bond auction around like an hour before that. And then I saw like, hey, why is the stock market moving up into the bond auction? What the heck? Are they going to be bullish on the bonds? Well, it can't be because of the meeting minutes from the FOMC, right? The Fed meeting minutes. That can't be interesting. Once it got released, the auction for the I think it was 10-year notes. Okay, it went up some more, then it came back down. But yeah, I don't know. It felt kind of funky. I was like, what? Something's going on, though. I didn't think like that was going to be a big deal. And then like 5 to 10 minutes later, Trump probably started talking because then I noticed the candle started going crazy. At first, it went down, it went up, it went down, it went up for like at least 3 minutes before it made a decision to fly up. All right, fly up. Okay, well, I'm just gonna set my sell orders up here. Then I didn't think it was gonna go this high. I thought like at most it would go to 520, like around here, and then give up, like get stuck, go sideways. But no, keep going. Must have been a lot of shorts up here or something because they just got blasted out. Hedging, shorting, who knows? But okay, went up here, decide to short. It's probably gonna go back down tomorrow, which is today, Thursday, because I didn't think the CPI today was going to do anything. So CPI comes, rolls over because it was good news actually, but it wasn't good enough to support like the SPY being above 540. So, okay, rolls over, rolls back down. Then I said like, okay, it bounced here, tried to get to 520, came back down. I sold. So I covered my shorts basically. All right, now it's here. Okay, that's the question we have to ask now. This is the same question I asked on Monday night. Was Monday morning the bottom? Right? That's the question. Or is it a bottom? Because we got a retest on Tuesday. And if you did, let me show you the futures market here. Okay? You can see if you looked at the futures market, so overnight, the S&P 500 retested the lows of Sunday night into Monday morning before the market opened. So it tested that, retested, and then by the time we got to pre-market and market open hours, it was just like, well, it retested it, it supported it, so I don't know what the shorts are going to do now because we already had enough news on China those past 2 nights. You had 2 nights of China news, right? China responds, Trump responds. China responds, Trump responds. So they can go up to two. So the title of this video, I said, hey, we can get to 200% tariffs on China. Does the market really care anymore? It doesn't seem to care. So if it cared, if it really cared, it would have went lower than this 480 area. It didn't, right? Now, of course, I didn't expect this huge move yesterday. So if I did, I would have put like more than 30,000 on these bets here, because I was in Sox L, and I was in, oh yeah, Bitcoin, right? I love my Bitcoin, so that stuff. But I mean, otherwise, it's like, come on, dude, come on. I didn't expect this. This is ridiculous because we still have China tariffs. So that's why I thought. I'm like, well, you still have China tariffs. You pause the other tariffs. All right. All you did was pause the other tariffs. So we're back to 10% retaliatory tariffs on all other countries except China. That's the only other one. I think the only other country that retaliated against like the U.S. was Canada. So besides China, it was Canada. But I don't think the market cares about Canada. So no, I don't think so. So most of this stuff is like, oh, okay, you get an overreaction on top, you pull back, good. That's what I wanted to see. That's exactly what I wanted to see, because if you look at the SPY hourly chart, this is perfect. You go up, you cross over the downsloping 40 hourly moving average. You got the upsloping 18 now because we got this nice green candle. Perfect. You go up, you pull back, you touch it. So midday today, we touched it twice, and we're moving on up. Now, what's going to happen tomorrow? Tomorrow we'll have PPI. We'll also have, I think, consumer expectations. I think we're going to have a new low on consumer expectations. But it's, you know what? If the market goes down tomorrow on those consumer expectation numbers, and I think that's around 10 a.m. after the market opens, and the PPI is 8:30, a half an hour before the market opens. That's Eastern time. I would buy a lot of longs at that point. Okay, so I'm still looking at a whole bunch of, because we have a whole week's worth of data now, because from Friday into Thursday, that's enough for me to look at stocks and say, hey, these stocks are going to be the best ones to jump in for trade or for long term. So what was the ones that I looked at long term? I remember I said MCK was a good example, right? Because it had very little damage going down, right? Okay, so Wednesday went up a bit, but it's so low volatile. So this is great for long term holding. You don't need to worry about what Trump does. This thing will just hold. So if Trump says something, it'll just go down, what, 3% at most. So the volatility of this stock is very low from at this point here. So it's not going to move big up or down, right? Now you could have other trash stocks like Lululemon. If you have a good bottom here, this thing could rally all the way back up to 365, no problem. So for trade, something like Lululemon would make more sense. Another one I saw was DNA, because today and yesterday it was the best performing little stock. So it made a bottom on Friday. It had a nice dip on Monday, higher low on Tuesday. Okay. All right. I'm liking this because now you're going to get to 10. And then maybe later on, you might get to 13 and maybe even 16 if we get a huge bump up. Because what I'm telling you now is that from the bottom of April, we can go all the way into July. And what did Trump say? Trump has a pause on the tariffs for 3 months from yesterday, right? You got 90 days. That coincides with the cycles perfectly. So this aligns very well from what I think. April to July will be a big move up in the markets. Okay, so it's a great thing that we got this huge dip in April, because then we can have a large rally into July. And then after that, what's going to happen? August will have problems with like budget issues. They're going to argue about budget stuff in Congress. And then that's going to go spill over into September. And also in August, the Treasury Department will issue new schedules for how they want to set up the bond auctions. If they're going to issue a lot of bonds, That's going to tank the bond market. This is a problem because here, let me show you guys. Let me show you what's happening with the bond market. This is not good. So this is the 30-year, 20 to 30 year. Look at this. Look at this. So even with Trump announcing the pause and all that, it's still down 7% this week. It didn't matter. Something's wrong with the bond market. And I found an article that explains this problem. So it was issued on Monday, but they talked about it last week. So I think this is good to talk about because this might be a reason to have a panic next year in 2026. Okay, let's see the other bond ETFs. So this is investment grade bonds down 3%. That you might think like, oh, 3%, that's nothing. No, for the bond market, that's huge. Bonds are not supposed to move up and down 2 to 3% in a week. They're supposed to be boring. This is way off kilter. Let's see, and then HYG. Okay, so it recovered a bit. So it's up. Oh, well, it's still down. Negative. It's pretty much like even. Okay, down 0.33%. But last week it was down 2.6% nearly. So this is high yield, risky corporate bonds. So that's not good, right? And I was talking about this like on Monday and last week. Like I was seeing some weird stuff in the bond market. I'm just like, uh-oh. You don't want to see this stuff. So the volatility, if it keeps going on like this, yeah, it might break something. But this is something you might watch next year. I don't think it'll break anything this year, but be sure to watch and pay attention. Okay, or if the China tariffs really scares the market, okay, fine. But so far, we're at 150%, I think, on tariffs on China right now, and China retaliated with 85%. I don't know. It keeps going up every night, but I don't think that's going to affect anything anymore. All right. Okay. So what else? What else goes to talk about? I think DNA was a good example. I mean, Nvidia. Nvidia's one when I saw on Monday was pretty nice. Okay, so when you look at like the candle on Monday, it was a pretty good candle, and I said watch Nvidia. If it drops below 94, run away, and it didn't, right? So that's a good sign. That's a good sign because Nvidia is one of those bellwether stocks. The other one is Tesla, and I said here if it dropped below 240, run away. So on Tuesday it did drop back below 240, right? And on Monday it never cleared 240. But yesterday it finally cleared it. So we're kind of in this like still sort of danger zone, but it seems a lot better now. Okay, so now Tesla at least is above a certain level. Nvidia is already been above a certain level, so that's good. But if you look at the semiconductors, this is bad. Okay, so I was long here. If I knew what Trump was going to do, I would have bet all in because this thing went up 18%, right? And then I was in Sox L. That sucker went up 50 something percent from the bottom to the top of that day. I was like, holy shit. Oh my God. I mean, yeah, Bitcoin was the other one because I was using MSTZ, right? Or X. I mean, X is the bullish one. Oh my God. This was nearly 50% too. I was like, oh shit. These were the best ones. But as you can see today, look at it. So I was short this one. I went to Sox X and shorted it. The thing is, like you can see, this is still weak, right? It's all we did was go back up to this range, and now we're slipping back down below it. Okay. So this makes me hesitant about the NASDAQ. The semiconductors is a real big component of the NASDAQ. We can't really rely on like internet to keep going up and like support the whole market or the Mag 7 and all. Like, all right, yeah, you need a lot of help because if SOXX is being this weak today, it was definitely about to like collapse and go down all the way down, but luckily it didn't, right? Because the VIX right now, if you look at the VIX, we're still at 40. Okay, so this thing, man, this thing is like it nearly touched 60 again today. Like this thing keeps trying to touch 60 every morning. It goes 60, touch 60, touch 60. So if you remember what I said, VIX at 16 means the S&P 500 can go up and down 2% in a day. So that means you multiply that by 2. 16 times 2 is VIX at 32 means you can go up and down 4% in a day. And yesterday the VIX dropped to 34, 35, right? Still above 32. So today shouldn't be a surprise. Today we went from 4% to 6% down. I think the QQQ almost hit 7% down in intraday, but we're still here. So we could still go down 6% tomorrow, right? 4 to 6% tomorrow again. So that's the worry. That's the worry. This thing isn't coming down in a meaningful way. It's still trying to bounce back up to 60, bounce back up to 60. If this thing continues to stay this elevated over tomorrow, Monday, and then Tuesday, right? So Tuesday is tax day. So who knows what that will entail? It might cause a shock in the markets if people start cashing out just to refund their banks just ahead of like midnight or something. You know, you can always be last minute with the IRS if you wanted to, because you're just so damn stingy about giving them their money early enough. Yeah, they could do that. So people could do that. If you have a big load of money in stocks, they might just be holding on and keep on trading this, and then up until midnight, then they'll give the money to the IRS. Yeah, they could do that. So this could go crazy all the way into Tuesday, right? It's just like, what the fuck are you guys doing? So because I think a lot of people are having fun right here, because yeah, every day I'm making like 5 G's, 10 G's, 20 G's, like, right? Like, and if you're playing options, hell, you're greedy as hell. Why not? So that's something you gotta keep in mind as well, especially when we have a weekend coming up too. I don't know what they're gonna happen in the weekend with China. China like might just keep going, like, okay, Trump, keep going. We'll match your tariffs with our tariffs and keep moving up. Eventually, it might scare the market, but so far, it hasn't. Okay, so let's see. Go back to NQQQ. So if we look at here, we bounced off this range. We touched it again today. We went back up, and if you look at the daily moving averages, this is perfect because we bounced yesterday all the way up to the downsloping daily 18 moving average, and we pulled back. That's normal. That's what you expect. The only thing we have to worry now is if the volatility will die down into next week, and we can be saying, okay, you will never touch below 17,000 again. If that's the case, then we're good to go. The other thing that you want to look at is XBI. So this is the most sensitive to interest rates, and it's a small cap, so it's going to be really affected by the gyrations of the market. It's still weak. Okay, it's still weak. Now, individual stocks, like I showed you, DNA, are being okay. They're trying to recover, but most of them are going down. Okay, so most of them on average are moving down. So these guys are like my favorite to short, because like today, if I shorted from here, I got down to here. So like, how much is that? So if I shorted at the close of yesterday, near the close of yesterday, and it went down here, that's 8%. That's very nice. So I use Lab D to short, so you can see how volatile it is, right? So this thing's crazy. So that was like 23%. So yeah, that's wild. And I don't like talking about this ETF, but here's one that you can like look at. It's called UVIX. All Seeing Guy knew about UVXY. Okay, so UVXY is like the VIX ETF that tracks the futures. I don't like talking about this stuff because this ETF tracks the volatility index, which tracks options. Okay, so they track the futures and the futures of options, like the options actual like implied volatility. So you're basically trading something that tracks something that tracks something that tracks something. So actually trying to figure out where the bottom and top of this sucker is like, I wouldn't bother doing this. I think you're better off learning how to trade options itself, because options have the volatility component built in. So if you want to take advantage of volatility, you should do it. Otherwise, yeah, if you're really interested in trading the VIX, you should just learn how to trade VIX futures directly instead of doing this nonsense. But if you really are lazy, all right, I'll tell you what to do. Trade UVIX. All right, because if you are lucky or you're really smart, you got to be smarter, because I'm not going to use this thing. But I noticed on Tuesday, it was so beautiful because I noticed like, oh, we jumped up 4% in the day, right? We gapped up, but I was like, man, it's having a hard time holding on. So I looked at the VIX. I said, like, well, let's see what the VIX is going to do if it rolls over. Look at this guy. So if I was trading UVIX, I would have got 67% in the day. In the day. Okay? So that was the best time to day trade the UVIX. So if you really didn't know options and you were lazy, yeah, you could have traded that particular day. The other time to trade was from yesterday's move to today. So let's say you got to the bottom of the UVIX yesterday and decide, well, I know today is going to go down. I'll just take a chance and say it's going to go down violently, because sometimes it just goes down, but it doesn't go down violently. That's not going to help. You can't trade this overnight, right? Well, I mean, maybe with Robinhood you might be able to, and interactive brokers, but in general you can't trade overnight. So you're taking a chance. You buy this, okay, on near the close of yesterday, and decide to gamble on today's move. And if you did that, you got 80%. Okay, so this is the best way to trade the volatility if you're lazy, I guess. So in this market, this makes sense to use this thing, okay? Because right now this market is insane since Wednesday, since Liberation Day. And if you want to trade this volatility, because I think this might continue on until next week, okay? But it might not, right? This might be over today. This might be the last day and we're going back to normal tomorrow into Monday. But hey, I don't know. I'm just telling you, like, maybe something to look at when you have a volatile market. So when the VIX starts going above 20 and you want to play stuff that acts like an option, okay, but you're too lazy to learn options, then hey, this could be something you could use. I'm not going to use it. I think this is dangerous because there's a lot of limitations in how you can trade this. Like, can you trade this thing overnight with confidence? This thing tracks futures, so there's like a lot of decay that happens. You're better off learning how to use futures then. It's like, and then the other thing too, if it's volatility that you want to trade, why don't you just trade options? Like, why don't you just learn how to trade options? I don't know. Using this thing is kind of ridiculous. But yeah, you can get some of that benefit because, as you can see, it moves a lot in a day, because this is how the options world works. Because volatility is your friend in the options world, and UVIX, yeah, is better than UVXY because this thing actually does 2x of the futures. If you did UVXY, you can see how much it does in comparison. So UVXY did 50% instead of the 80% here. UVXY did 50% instead of the 100% there. See, there's a big difference. So if you use UVIX, you'll get a lot more gains. But if you do it wrong, yeah, you'll lose a lot too, right? If you don't set your stops and all that. So that's something just to tell you guys if you're interested in doing that without options, just in case you wanted to do that. But for me, I'm not going to play that game. Okay. I'm going to read the article now. I think that's what I'm going to do. Okay. Well, let me look at oil. How's oil doing? Oil went up yesterday, but it's pulled back 4% today. So that's a lot. Down 60%. Okay. I mean, not 60%. I mean, $60 a barrel. Yeah, $60 a barrel. Nat gas jumped up yesterday too with it, but it pulled back hard. So we're back to where we were kind of before Trump did anything. So back to $3.50 cents million BTUs, British thermal units. So yeah, so I think we're still stuck here. I don't think there's any rush. I could see it going back to $3, and that means boil. Like I said last week, I said boil. Well, I could see it going to 50, and I'll buy it back at 50. So yeah, if it goes back to 50, I might buy it back there. All right, boil for the spring. I mean, not spring. We're already in spring, but for the summer. So yeah, maybe we'll see. We'll see. Okay, and let's see what else. I talked about bonds already. I'm going to read an article about bonds, and here, let me play this WTI video.
The United States has emerged as an oil export powerhouse, making the price of WTI essential for global trade. In 2024, 37% of WTI trading volume originated from outside the U.S., up from 29% the previous year. As European and Asian refiners have been adopting NYMEX WTI-based pricing for their cargoes, the majority of new WTI participants have also been from overseas. In 2023, U.S. oil was added to the basket of deliverable grades for Brent futures. Since then, U.S. WTI Midland crude has set the price of dated Brent more than 50% of the time, highlighting that Brent prices are rooted in the U.S. and helping to drive international adoption of WTI. The NYMEX WTI light sweet crude oil futures contract has been around for over 40 years, underpinning the price of crude oil around North America and now overseas. With crude oil on the Gulf Coast valued and traded as a differential to WTI, growth in the importance of U.S. oil around the world is synonymous with growth of NYMEX WTI at Cushing.
All right, guys. So, let me tell you about China right now. So let's get the China market here. So if you remember, this is what I drew way back when last year. I said spring test, last point of supply. So this is a YCOS stuff, right? And I drew this gray line as kind of like a model of where I think it will go. So far since February, because of DeepSeek AI and all the stimulus, China has overshot up and it came back down. Now we are down here. Okay. So, is it time to buy Chinese stocks or not is the question. So, let's look at the K-Web ETF. We're still at the bottom here. There's no rush to buy this stuff because this looks really ugly right here. And like, let's look at my favorite Chinese stock so far. KC. Okay, this one at least tried to bounce above 10. Not bad, not bad. So, I might re-enter shortly at some point. So, definitely the Chinese stocks here, tech stocks can be looking good. BYDDY, perfect. Bounce off of 83. Okay. How about Xiaomi? XIACY, bounce off of 22. So my favorite Chinese stocks have bounced off of their support. Now, will this hold or will this just go sideways? That's my question, right? Let's get Baba. I'm not in Baba, okay, but we went through the range and we fell underneath the range. That's not a good look, but we're still hanging around this weekly moving average going up. So like 18 and 40 week moving average. JD, a lot uglier chart, but at least it's trying to hold 35. Let's look at Tencent. Still in this range here. We just fell just below it, 56, 57. Okay, TIGR, a fintech, still in a range. Futu, probably still in something. Yeah, went this now. Oh, this looks uglier. So yeah, some look okay, some look bad, right? And so that's why BYDDY probably the only one, Xiaomi, and then KC. So those three look okay for now, but they could get hit tomorrow, next week. They could get hit next week because if they keep going back and forth on the tariff stuff, these guys might suddenly just collapse. But But, but, let me play this video. Now, this guy probably just wants to pump his ETF. So I don't know if I can trust his bias on this. He's going to say like, oh, Chinese tariffs are okay. They don't matter to domestic consumption, because those stocks that I mentioned, they sell to Chinese consumers inside China. So what does a tariff matter to that, right? The only reason it would matter is if it starts affecting the Chinese ability to manipulate their currency. That'll be the only way. So let me give you some videos.
Now seems to be a lever that the Beijing authorities are looking at pulling right now as the trade war intensifies. What's the likelihood we're going to see a sizable depreciation of the CNY and CNH against the dollar?
I don't see much of a likelihood in that direction because it's not in China's best interest. So right now, it would be weird if the central bank doesn't respond this way, because it has to allow more of volatility within that 7 to 7.3 range to counter the tariff pressure. But a bigger worry for the central bank has been the capital flight. And what if this devaluation expectation is embedded in the financial market? Just imagine that is not a weapon actually for China to use. It's more like a financial suicide if China let the market believe it will let yuan slide.
Okay, financial suicide. I mean, you can't put it more strongly there, even though we do have names like Jefferies, for instance, saying there's a 75% chance now of devaluation. So talk us through then the conversations you've been having with people.
So someone asked me on Monday, hey, is China devaluing their yuan in response to the tariffs? And I looked at the chart. I'm like, well, it is lower, but not significantly lower. And I told them, I don't think China wants to do that because they'll shoot themselves in the foot long term. So I think this analyst here on Bloomberg is echoing what I'm feeling. I don't think China wants to do that. They can do that if they're desperate, but it's going to be bad.
In China over the past couple of days, and sort of the sentiment or messages that you're hearing?
Well, a lot of people do worry that at some point maybe the central bank could let yuan slide if the pressure from the US is getting too big. This 50% or even 60% of tariff, if actually become true, that's an essential decoupling of China supply chain from the rest of the world, and that's detrimental. And in that situation, I still believe the central bank will try its best, and it has the credibility to actually defend the yuan. Just think about that 3 trillion foreign reserve. Technically, China's central bank can fix the yuan at any point it wants. And one more point to that, at this point, the bilateral trade between China and the US is not the most important one for China. The trade relations with its other trading partners is way more important. And there's a lot of hostility towards Chinese export in the past few years. It's about dumping or crowding out the local industries, especially in auto or in the green industry. So for China to improve the bilateral relations with other trading partners, it's a much bigger concern. So maintain a stable yuan or even revalue against dollar at some point is really to China's best interest.
Well, Don, how active must the national team, whether it's Central Huijin Investment, the Sovereign Fund, and others, to prop up not only the markets, but to prop up sentiment?
Well, they're quite crucial, and people have been waiting for this. Although Central Huijin's action, as you have seen, didn't yield much of an impact on the stock market. It didn't reverse that downward trend. But the fact that the national team is ready and there will be more to come is a bolster for the market confidence. And to invest in Chinese stock market, the rationale behind it is quite different from investing in other market. Chinese stock market is quite isolated from the rest of the world and highly controlled. And many people see it as a breeder for future good companies. And China is producing some of the world's leading companies now. And for anyone who's having an eye on China, they probably are viewing like automation, AI, whatever transformative technology for the future. So the investors, after this round of panic mode, probably will return to Chinese market. I actually see less of a chance of Chinese stock market slide much this year. It could very much likely to outperform.
Well, that's where I was going to go next, Don. You believe that the markets will outperform despite all this negative sentiment right now. So end of the year, we're talking maybe S&P down and the CSI 300 up. That would be quite a prediction.
Well, it's all in relative terms. So previously, people didn't have this expectation that the dollar might be weak in the midterm, and that yuan might be strong. And also, relatively speaking, Chinese domestic economy is in a more stable mode than the U.S. There is a high chance that the U.S. will enter a recessionary period. But for China, reaching the 5% of GDP growth target is still very much likely for the government and also for the general public to believe. So one thing I want to point out is China as a producer for this world is in a much stronger position at this point, because demand can be generated out of thin air, but supply is real. You have to actually invest to be able to produce a lot of the stuff. So although the U.S. is imposing more tariffs on China now, but one way or another, it has to pay for a big portion of that cost. And the fact that Chinese yuan is maintaining a relative strong position against dollar is imposing part of that cost onto the U.S. buyers. So going forward, there will be a bigger pressure on the U.S. Than on China.
Well, Mr. Chris Reed, I think that answers your question, right? It took how long for us to export our manufacturing to China? Like, how long was it? 10 years, 15 years, 20 years? So even if we're going to turn back now, where are the factories in America, right? It's going to take a lot of effort to bring things back here. And this was a slow burning process. You know, when I was working, I've heard a lot of stories like people were being outsourced. You know, they were told to train people in the Philippines, China, India, what they knew. And then after they were done teaching people what they knew, they got fired. They got laid off in America. So, and this was many years. It takes a long time for you to lose all your talent, right? And all your knowledge base. And yeah, I mean, I don't know. I don't want to really get into it because it's a big problem. It has been a big problem. It's kind of too little, too late in a way. I mean, I'm glad that someone's noticing these things now, but it's like, bro. Like, yeah, there's a cost, you know? Like, yeah, okay, you get cheaper goods. In the short term, you feel like, yeah, you're going to get some benefit out of it. But in the long term, you got to have trust in your partners. If you're not going to have trust in the Chinese government, right? And you thought like this stuff was going to somehow create democracy in China with a stronger middle class, that isn't going to happen. Okay. So anyway, we'll see how this goes. But for now, I would say yes. We are at a changing time. We are at the precipice of change. All right, and we have been on this precipice for the last 4 to 5 years, starting with the first administration of Trump, first term, and it started continuing and simmering there because Biden kept those tariffs on China. So a lot of those, and he increased the tariffs on China. So after the Ukraine incidents, you know, they lost even more trust in China. So it really doesn't matter. I think China doesn't matter what party you belong to. I think, yeah, if you ask someone behind the doors, yeah, they want to punish China however they want. Okay. All right, let's go to the gold. Let's look at the gold. because I think this relates to what we want to do about currency manipulation. So I was shorting gold from here last Thursday, right? Into Monday. And then all of a sudden, we had a little bounce on Tuesday, fell back with the rest of the market. Okay, whatever. And then Wednesday, we went up. But today, look at this guy. Look at this guy. So gold miners went up to a new high on the ETF. So GDX went up to a new high. Okay, we have a closing new high. And if you look at something like Kinross Gold, KGC, I was like, whoa. Hey, so this is my favorite gold miner. I was like, whoa, what? Look at this. It's made a really new high. This guy went from $11 to $14. So I'm like, what? Hold up. So, I think silver's still in the downturns. Silver's still stuck. But gold making this nice move here. Okay. So for sure, at least, I could say like we're going to go sideways for the next quarter or two, at least. So even if we can't sustain this new high, I could say at least that this structure here on gold is still holding. Okay. So let's look at silver. Yeah, silver's still stuck. Man, this guy's still stuck. So we're still $31 an ounce. Okay, we're still stuck. But if I look at the futures on gold, let's see, 31.88. Okay, 31.88. So 3,188 on gold. So yeah, this is pretty strong. So only we got like some hiccup because the tariff stuff from Liberation Day kind of caused a liquidity trap here. Okay, so but then today, what I also noticed was the dollar started going down some more to 101 on the DXY. So let's look at the yen. So we got 144 yen to a dollar now. So I don't know if that's a good thing. I don't think it is. And I think, see what the euro's got. Oh man, I think euro USD. Let's see. 1.12 euro for a dollar. Okay, so yeah, euro. Everyone ran to the euro today, apparently. You probably want to buy European stocks because I noticed a lot of European stocks really just kind of like just recovered, because like it barely got hurt, by the tariff stuff. So like, okay, Rhine Metal went down 12 something percent. It recovered that. Okay, that was back in Friday. Okay, last Friday. So and it just shrugged it off. So that was nothing, because so far it already went up 100% from February. So it doesn't care. So that's why I was like looking at a lot of these European industrial stocks, and I was putting that into my list, okay, of things. So that's why I was like, okay, this stuff we got to look at. Okay. All right, I think that's it for those charts. Oh, let me look at Bitcoin. Look at Bitcoin. Let me see what we got here in Bitcoin. Okay, we ran up to this declining 40-day moving, 18-day moving averages. We pull back. Okay. Yeah, I mean, maybe we're good because I said like I feel like we're at a bottom for Bitcoin since last week, honestly. I don't think we're going to make a new low. I mean, we still could go if there was a shock in the markets, it could still go to 69,000, but I mean, if you look at MSTR, you see that it hits the bottom here at 240 back in March. And again in April, and we're back here. Once we're done with this whole range, we can finally move up into May and July. Okay, May, June, July. That's where the next crypto move will be. Okay, May, June, July. So we're already teasing the bottoms here. I mean, was that really the bottom like on Tuesday? Because we got a nice, real good deal on MSTR. So that's why I bought a lot of like MSTX, but I didn't know Trump was going to say anything yesterday, but I did buy it on Tuesday. And I was like, if I knew that, I would have freaking hell, man. If I knew it was going to jump up 50% on my MSTX ETF 2x leverage, shoot, I would have got a lot more. Oh well, whatever. That's the game here. I can't predict you the actual price is going to go up day to day. All right. All I can tell you is like, okay, there's support, there's resistance. Play it how you want to play it, because we got here on Tuesday. We got a new test of this area. We jump up, we fall back. Okay, let's see what's going to happen here at 270. We closed at MSTR. So this is one of those stocks I'll probably highly recommend going into May. All right, because I think Bitcoin, once it's done, it's going to like over 100. I don't know if it can hit like 180 or 200K, but at least it can go back to 130. So okay, so the highest we got on Bitcoin was basically what, 108,000. So we could probably just hit like 130, 120, 130 at least, and then we'll see what the other, like, if you're interested in the other cryptos, I'm sure the other ones will follow, but we'll see. Yeah. Anyway. Okay, that's it about that. All right. Now, let me read you the articles here. So let me see if I can find it. Gotta find these articles because they're kind of stale now. They're kind of stale. Blah blah blah. Okay, let me see. Okay, here we go. Yeah, this is gonna be important. Okay, you guys listen to this one. All right, I think this is gonna be important. All right, here we are. Financial Times. You know, I like the Financial Times. All right, this was 7 hours ago, huh? So this was like two days ago, pretty much 2 days ago. All right, put some music on. Put some music on. The Treasury basis trade rears its head again. What is the Treasury basis trade? Yesterday, our main FT colleagues published an important story about some of the U.S. government bond market's weird behavior lately, which unfortunately quickly got buried by the unending avalanche of other news. Fortunately, it also helps explain why U.S. Treasuries have gotten hit hard again today, despite the stock market dipping back down again on more bad tariff headlines. From Monday's story with AlphaView's emphasis below, U.S. government debt sold off sharply on Monday as hedge funds cut back on risk in their strategies and investors continue shifting into cash during a third day of acute tumult on Wall Street. The benchmark 10-year Treasury yield jumped 0.19 percentage points on Monday to 4.18%, the biggest daily rise since September 2022, according to Bloomberg data. The 30-year yield jumped 0.21 percentage points, the biggest move since March 2020. Investors and analysts pointed in particular to hedge funds that took advantage of small differences in the prices of treasuries and associated futures contracts, known as the basis trade. These funds, which are large players in the fixed income market, unwound those positions as they cut back on risk, prompting selling in treasuries. Hedge funds have been liquidating U.S. Treasury basis trades furiously, said one hedge fund manager. The sell-off has now continued into Tuesday, with the 10-year Treasury yield climbing 4.29% at pixel time. That's a pretty chunky move of 13 basis points on the day, and the 10-year yield has now seesawed up 42 basis since its low on April 4th. That's pretty noticeable, given that risk-off remains the dominant sentiment. As Bespoke Investment Group's George Piarkis wrote in a report today, while the historic reversal in stocks today that saw the market close near the lows down over 1.5%, having been up more than 4% at the highs, is concerning. The rumblings in fixed income feel far more problematic. Over the last 2 days, 30-year U.S. Treasury yields have risen a brutal 35 basis points. While that's not an all-time superlative, it's extremely unusual in the top 0.4% of all 2-day moves for the long bond yield. What's much more unusual is the fact that this large surge in bond yields has come with stocks dropping. In fact, this is the largest 2-day increase in 30-year yields, with stocks down at least 1.5% over the same span since 1982. All right, you scared, guys scared enough? It's always hard to disentangle market drivers, and there are probably multiple culprits behind the Treasury sell-off, such as a weak auction in 3-year notes and the Treasury swap spread trade unwinding. But the Treasury basis trade appears to be a big factor behind the cracks in the U.S. government bond market. As many Alphaville readers will know, we are above average interested in the Treasury basis trade and have been ever since it scared the bejesus out of us back in March 2020. For the uninitiated, here's a quick explainer of what the Treasury basis trade is and why it's potentially problematic. Treasury futures contracts typically trade at a premium to the government bond you can deliver to satisfy the derivatives contract. That's mostly because they are a convenient way for investors to gain leverage exposure to treasuries. You only have to put down the initial margin for the nominal exposure you're buying. Asset managers are, as a result, mostly net long treasury futures. So in other words, people don't need to actually buy the physical bond, quote unquote physical. They can just buy paper bonds. All right. Well, bonds are already paper anyway, but this is even more paper than the actual physical bond. However, this premium opens up an opportunity for hedge funds to take the other side. They sell treasury futures and buy treasury bonds to hedge themselves, capturing an almost risk-free spread of a few basis points. Normally, hedge fund managers don't get out of bed for a few measly basis points, but because treasuries are so solid, you can leverage the trade many, many times. Let's say you put down $10 million for treasuries and sell an equal value of futures. You can then use the treasuries as collateral for, say, $9.9 million of short-term loans in the repo market. Then you buy another $9.9 million of treasuries, sell an equivalent amount of treasury futures, and repeat the process again and again and again. It's hard to get a firm idea of what is the typical amount of leverage that hedge funds use for treasury basis trades, but Alphaville gathers that as much as 50 times is normal, and up to 100 times can happen. In other words, just $10 million of capital can support as much as $1 billion of treasury purchases. You guys scared yet? And how significant is the trade in aggregate? Well, it's an imperfect measure for a lot of reasons, but the best proxy for its overall size is the net short of treasury futures positionings of hedge funds, which currently stand beyond $800 billion, which asset managers the mirror image on the long side. All right, you can take a screenshot of this. The problem is that both treasury futures and repo market demands much more collateral when there is an unusual amount of volatility in the treasury market. So what does that mean? That means if the treasury market is going crazy, going up and down like 2%, because I showed you the chart, right? 2% Well, in the stock market means nothing. Even 2% in the S&P 500 is a lot, but let's say for an individual stock, 2% might not be much. But for the bond market, the whole index moving 2% is huge. So the problem is, what happens? The collateral, right? So if there is unusual amount of volatility, you need more collateral. And if hedge funds can't pony up, then lenders can seize the collateral so they can take away those treasury bonds and sell them into the market. So if they start taking away these hedge funds' collateral and just dumping them indiscriminately into the bond market, that will cause the bond market to get even more crazy. So there's more supply of bonds than actual demand. Okay, as a result, it is a major danger lurking inside the market that is supposed to be the financial system's equivalent of a bomb shelter, as Apollo's Torsten Slock pointed out earlier today. Why is this a problem? Because the cash futures basis trade is a potential source of instability. In case of an exogenous shock, the highly leveraged long positions in cash treasury securities by hedge funds are at risk of being rapidly unwound. Such an unwind would have to be absorbed in the short term by a broker-dealer that itself is capital constrained. This could lead to a significant disruption in market functions of broker-dealer firms, such as providing liquidity to the secondary market for treasuries and intermediating the market for repo borrowing and lending. We saw exactly how this latent vulnerability can morph into a systemic risk in March 2020, when a dash for cash by foreign central banks and bond funds swamped by investor withdrawals were forced to ditch the most sellable asset they had, U.S. Treasuries. That in turn pummeled hedge funds that had put on monstrously leveraged treasury basis trades and threatened to turn a messy bout of treasury liquidation into a cataclysmic financial crisis. Okay, so this is good to know, because we are testing the limits of how things can go into 2026. This is just a preview, all right? I don't expect any problems to happen this month, all right? But I want you to take note of what's been happening in March 2020, COVID lockdown, and again here in April when we had the tariff stuff. Anything could shock the market, right? We're not at that point where it's crazy yet. The Federal Reserve will step in when things get wild. Only Herculean efforts by the Federal Reserve, its balance sheet expanded by $1.6 trillion in just 1 month, prevented it. What happened late on Friday and on Monday is nothing near what we saw in March 2020. Yep. What we've seen so far is nothing. Nothing. If you guys remember 2020, like March 2020, that was crazy. The bedrock for the entire global financial system came close to a breaking. But as our colleagues pointed out, the volatility has been high, and that they sold off so violently yesterday is highly suggestive of at least some levered treasury trades getting forcibly liquidated. So yeah, you can see like the history here. Many regulators and policymakers have been worried about the treasury basis trade ever since, not least because the Fed's action constituted a de facto bailout of the strategy. That the basis trade has since swelled to become far larger than it ever was before March 2020 has understandably increased those concerns even further. And guess what? We are going to change how the treasuries are issued in August. We are also worried about the debt, right? Nowadays, and how we're going to pay for the high interest rate bonds. These things can also cause panic. So we'll see. Unfortunately, doing something forceful about it is difficult precisely because the basis trade has become such a major pillar of support for the treasury market at a time when the U.S. government's borrowing costs have already ballooned. As Citadel's Ken Griffin noted back in 2023, when the SEC's then head, Gary Gensler, had the strategy in his crosshairs, killing treasury basis trade would increase the cost of issuing new debt. Oh, man, we're stuck. So they can't pop this balloon without like causing problems with paying our debt, which will be borne by U.S. taxpayers to the tune of billions or tens of billions of dollars a year. So far, it doesn't seem like any basis trade liquidation is having major disruptive effect on the treasury market. What was scary in 2020 was both how yields moved up when they should be moving down, and how trading gummed up completely in an asset class that nowadays often sees about $1 trillion of trading a day. That doesn't seem to happen so far, even if treasury yields moving higher on risk-off days like today is a bit disconcerting. However, Bloomberg's index of treasury market liquidity has been a little loopy lately, so this is one to keep an eye on. Well, I don't have a Bloomberg terminal, so I don't know how it's looking right now, but yeah, this looks pretty bad. All right, so yes, let me give you a link to this article. I think this is very important to refer to later on. Okay, I think you guys will have to remember this one when we get to 2026. Something will happen in 2026. I don't know what, but yeah, please check out the link there. Okay, archive.is/E capital F49 capital I. All right. Okay, let's see what this other article is. I don't think this one's very interesting because the Financial Times article is much more comprehensive. Okay, but I'll read this one anyway. Yeah, this. Let me give you the link. I probably won't read all of it. Let me get through this one. Okay. April 8th, 2025. Treasury yield surge stokes fear of next big basis trade unwind. An unnerving development is starting to unfold as President Donald Trump trade war hammers financial markets. U.S. Treasuries, far from offering shelter from the turmoil, are suddenly losing their haven appeal. For James Arthey, it's bringing back memories of the basis trade unwinds at the onset of the pandemic, when widespread deleveraging sparked blowups of the popular hedge fund strategy that sent bombs tumbling. Bonds, not bombs. While there's little concrete evidence of dealers cutting off financial financing of hedge funds getting caught wrong-footed thus far, he can't shake the feeling that recent moves are just a taste of the hidden risk lurking beneath the surface of the market. Okay, so yeah, I think this is pretty much similar to what I already read. Blah blah blah. Let's see. Ed Al-Hunsani, a rate strategist at Columbia Threadneedle Investment, is certain that basis trade deleveraging has played at least some role in pushing long end yields higher in recent days. He points in part to the fact that the gap between 30-year swap rate and similar maturity treasuries had its biggest one-day move in years on Tuesday, as evidence touching the lowest on record. That is consistent with the basis trade unwinding at the 30-year point, which is where most of the juice is. Okay. All right. Swap spreads tanking. Okay, this is a pretty good one. Yeah, you should read both of these then. I think this thing covers a lot of stuff here. All right, yeah, definitely. I'll definitely keep these in mind. I'll definitely reread them when we go down closer to 2026. And I think it's very important because, you know, China has tools, right, to attack. If they're desperate, they could devalue the yuan. The other thing is they could dump the treasuries. That will increase the value of the yuan, actually. So maybe they don't care anymore. They might not even care. They might be fine with increasing the yuan level and dump U.S. treasuries just to punish us when we're sensitive. If they know the right time to hurt the bond market, maybe they'll do that. That makes me think. That makes me wonder. So yeah, they got weapons they can use because we given them so many bonds over the years. They've eaten up all our bonds. Now let's look at where we're at here. I think I want to do a little review. Let's review some stuff here. Let's look at the QQQ here on the hourly chart. You can see we are almost like in a duckbill shape on the MACD. you know? So, yeah, I think we're nearly out of this bottom on the QQQ. If you look at the S&P 500, yeah, we're almost there too here. We just got to go a little bit further up, and then this thing crosses and we're good to go. We're ready to fly up. But if tomorrow and Monday isn't a good thing, what's going to happen? Well, this will be a false signal because we haven't even confirmed anything. This will just roll over and we'll just go back down below 500. That is not what I want to see in S&P 500. Okay. What about the QQQ? Yeah, I don't want to see this thing roll over below 425. Yeah, I don't want to see that happen either. So we'll see. We'll see what happens. We'll see what happens. But yeah, the bonds, they could wipe it out. They could say like, hey, if you want to keep fucking around, you'll find out. And we could just dump all our bonds, create a huge panic in the treasury market, blow up the bond market, the U.S. Treasury bond market. That'll blow up the corporate bond market, and then they'll blow up the U.S. stock market. Like everyone knows it. This is like a Mexican standoff. Everyone here is holding guns at everyone else. That's basically all we're doing right now. So I have no clue how this is going to get resolved. But yeah. So here, the TLT is back at 86. Not a good look. Definitely not a good look. And you got the dollar at 100 right now. Okay, Dixie is at 100. Let me see. Yeah, we're right back where we were in September 2024. All right. So we've been in this range. I don't know if we can go any lower than that. That's pretty big. I would not want this thing to go down to 90 right now. That's going to create too many shock waves. And let's see where the U.S. oil is. Right back at 60, right? That's what I said. Okay. Yeah, I think we kind of touched 55. That's where Trump wanted it on Wednesday. So this was before Trump started talking. This was like right during just before the EIA released its weekly numbers for consumption in crude oil and supply demand for gasoline. So I don't know. We're gonna have to watch that too. Okay, let's see what other videos I got here. So we got about an hour here. We're done with an hour. Not too much else, I don't think. Okay, this is the last video I'll play. I think this was interesting. I think someone found a math error in Donald Trump's tariff calculations. Let's see what this one's about.
Based on an error that's having massive consequences.
It is an error, and it's not just an error in the math. The whole concept of defining a tariff solely based on the trade deficit the U.S. has with another country is conceptually flawed. So just on top of that, they made another error, which actually, even if you buy the way that they created this formula, it overstates tariffs by a factor of 4. And in fact, if you applied the right parameters, you would have the vast majority of countries having the minimum 10% tariff, and the maximum tariff would be 14%.
So essentially, whether you have a trade deficit or a trade surplus, you will get slapped with a tariff of 10%. Is that a good way of looking at it?
That is the way that the tariffs have been implemented. Economically, of course, that's not a good way of looking at it. If you really wanted to get reciprocal tariffs, you'd have to do the hard work of figuring out exactly the tariffs that other countries place on the various products that they export into the United States. You'd have to calculate some of the non-tariff trade barriers that they do impose. I actually have heard some of that work was done within the White House, but the president ended up ignoring that analysis and instead decided that the tariff should depend only on the trade deficit with a given country. And the problem is that while it's true that a trade deficit would depend in part on tariffs, it also depends on a lot of other factors, such as comparative advantage. So what types of goods that a country is particularly positioned to produce and whether the U.S. would be consuming those goods depends on geography and numerous other factors. And so you really cannot create a formula for a tariff solely based on the trade deficit.
Including international trade flows as well. If you take a look at the tariffs being imposed by the Trump administration, we're looking at 26% for India, where I am right now, 34% for China, 46% for Vietnam, 50% for a small nation like Lesotho, which is among the poorest nation in the continent. I'm just wondering, if you were to remove the ERA, what kind of tariffs should these countries be implemented with?
Sure. If you remove the error, it's a very easy calculation. Just take whatever the tariff is that the Trump administration published for each country, divide it by 4, and that's essentially your new tariff. And so if you believe, again, their formula, the highest you would have is about 14% or a little bit less than that. Now, I would not suggest that those are the correct tariff rates. I mean, if we're trying to do reciprocal tariffs, which I am not a fan of even, but if you wanted to do that, you again would need to do the work of calculating what their tariffs actually are placing on the U.S., add in the non-tariff barriers, and that would be the right place to start. But I think the president just doesn't think about it in that terms. He believes that if there's a trade deficit with the country, that means that country is cheating us. And that's just not true, especially when you get to some of these lower income countries that just simply are not consuming some of the goods that we're producing, and they get it from other countries. There's a lot of countries out there, and there's a lot of flows between them, and it just doesn't make any sense to punish other countries, first of all, but mostly to punish ourselves. It's going to increase when we put tariffs on. Consumers pay a portion of that increase in prices. It's going to make it harder for businesses to have any certainty in the U.S. About investment decisions, and you end up hurting everybody. And I think that's why you're seeing such a large market reaction in terms of the stock market and in terms of increased probability of entering a recession in the U.S. So this is good for nobody.
Kevin, there is a quotation here which says, nobody knows anything. Those responsible, those implementing, have no idea what they're doing. First, do you agree with that? And secondly, if you had to make sense of what's happening right now with those tariffs, how would you do it?
Yeah, I think it really comes down that there's just conflicting motivations. I mean, some people, I think, within the administration, want to raise money. Import, if you tax imports, that's going to raise money for the Treasury. Some people see this as a way to, create more manufacturing jobs in the U.S. Some see it as a negotiating ploy to say we want to have free trade everywhere. And I just think there's not really an alignment of what the ultimate goal is here. And I think that is a big problem. Aside from the policy itself, it just creates total uncertainty. So if you're a country who wants to say, oh, wow, I really want to comply, I want to not face these big tariffs for things that we're exporting into the United States, I don't think they would know what to do because we're not giving them, the Trump administration is not giving them any kind of clear direction. So I think that's just the clarity of what the goal is, and then what countries need to do to comply would be an important step. Again, the fundamental thing is we shouldn't want a trade war in the first place, but if you're going to declare a trade war, at least define the terms clearly.
Another head scratcher, I think, is the trade war over fentanyl. That doesn't make much sense either.
Right. So this was an earlier motivation. So it seems that the motivations for the trade war have changed day to day and month to month. And I think this goes back to the lack of clarity. But, this started a month ago, actually a couple of months ago. The Trump administration decided to impose tariffs on our two neighboring countries, Canada and Mexico, under the guise of fentanyl. Now, fentanyl is a very serious problem. The drug epidemic in the United States claims 100,000 lives or more per year at a staggering economic cost, not only to our economy, but also just the lives lost in senseless ways. So it's a huge problem. But the problem is that it's not caused you can't solve the fentanyl problem by putting tariffs, particularly on Canada. I mean, a lot of fentanyl does come through the southern border from Mexico. Fortunately, they've been cooperating with us to help alleviate those flows. 0.2% of all the fentanyl that comes to the U.S. comes to the border with Canada. And so that just suggested to me, like, the administration isn't serious about these other reasons. It wasn't serious about the drug war. It was serious about putting tariffs on our neighboring countries simply because they are a large source of imports into the U.S.
Kevin, I want to touch on China just because Trump said just overnight that he's considering 50% additional tariffs on China. I'm just wondering, where should those tariffs be without the era?
I see. So again, if you take their formula, with China, there's been a layering of other tariffs on top of original tariffs. So I'd have to go back to our table and what they published for China. But I think with China, it's a little bit different to some of the other countries. There are some concerns about unfair trade practices that they engage in. So I think there can be reasonable ways to deal.
Right. Let me get rid of this. Let me see.
Back and forth.
All right. I think that's it. That's the end of that. Okay. So I think I had another video here, but let me show you this first before we continue. So I'm gonna pump up some Chinese stocks with one more video, but first let's look at this. All right, let's look at this. Let's look at this chart here. All right, so what you're looking at is a cycle chart of the XOY over XOP ratio. XOY over XOP is discretionary over staples. Okay, I'm using this as a signal, right? So yesterday we had this nice hourly move up. So this is a hourly data set. So these are hourly cycles, and the bottom of this cycle is around like 10 today, which is 10 of April and 11th of April. Okay. So we're here. That's what I was expecting. So we're here. Was that the bottom or was that a bottom? That's still a question. I still got my questions. All right. Now let's look at another chart. Okay. Let's look at another chart. Okay, let's see this one. This is the S&P hourly chart here. Now this one says around 8 to 9 would be where we have our bottom. So that looks like it's confirmed, right? We moved up. Now we're going to pull back, see how far we pull back. And I think we were on our way up until April 18th. And that's just the hourly. Okay, that's just the hourly. Now, if we look at the daily, if we look at our daily chart, I'm going to show you that just to remind you. Okay. So let me get the ES futures chart here. Get that. All right. Put that up. Blah, 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 blah. Okay. Let me see. Okay, let me get that. Okay. All right. Now let me share my screen. All right, here we are. Okay, so let's put on some cycles here. The 180-day cycle. That's important. So we're near bottom already. We'll add this one here, 124. Okay. And this thing will go all the way into July. So July 9th. July 8th, which is what? 3 months after the pause, right? We're pausing for 90 days. So we got April, we got May, we got June, and then the first week of July, boom, we're rolling back over. How convenient. How convenient. So we got this whole ramp up here. Okay, so this is what we're waiting for. This signal hasn't been confirmed yet, because maybe next week we go back down. Hell do I know, on Monday. Like anything could happen, right? Seriously. But like I think we already completed a bottom, right? I think I'm convinced about. I'm pretty much convinced. I don't think Friday is gonna be crazy. I don't think Monday is gonna be crazy, and I don't think the tax day is gonna be crazy. But I'll leave the door open. I'm gonna leave the door open. But yeah, when my Substack goes up, I'm just gonna pump out like a whole bunch of stocks to be looking at, because we got a whole 3 months of fun times going up here. So if you think yesterday was fun, there's gonna be more fun. There's a lot of stocks that are still beaten up. Like let's look at United Airlines, right? United Airlines. Oh, United Airlines was up 20% yesterday. Man, bruh, it's been down 50% for the whole like year. We got plenty of time. Don't worry about it. Don't worry about it. Okay, so yeah, you got plenty of time to look at. All right, so that's what I want you to focus on, the big picture, because we got 3 months here of a move, and we're about to be done with a bottom being made. And the other thing too is to look at Chinese stocks, and I can't say enough. And maybe I'll look at some European industrials as well, add to that, and we'll find a bunch of things that we can look at. Okay, so let's play the last video here. This guy's going to pump his ETF on China, I'm sure. It's going to be a lot more advertising.
On set, Brendan Ahern. He is Chief Investment Officer at Crane Shares. Do you have any hot take on what the hell's going on here?
Well, I think we need an offer.
I'm trying to come up with some genius questions that make me look smart, but all I know to ask is about the market action and let the market tell the story. And the story right now is not good.
No, not at all. Particularly, I mean, we have to remember that 2/3 of global equity market cap is in U.S. stocks. China's less than 3%. So the pain here is really felt by U.S. and global investors who, after a 16-year bull market, are very, very exposed to U.S. stocks. Obviously, U.S. economically is really going to suffer under tariffs. The Walmarts, the Home Depots, Costco's, these import cheap stuff from China. It has no value to make it here, to build it here would have
why are you
a big
guys
environmental consequence.
Yeah, so why are you guys being sold off then?
I think it's a knee-jerk reaction because of the geopolitical. It doesn't make any sense. KWEB has basically zero revenue exposure to the United States. So just because there's China in the name, it's getting puked up. But the end reality is the companies in KWEB have no exposure, and they're going to be beneficiaries where China's actually doing something that the Trump administration wants, which is they're focusing more on domestic consumption. And they've been stimulating, but you're going to see an acceleration of that stimulus. It could happen at any moment's notice that they pull the bazooka again, as we saw in September of last year. It's definitely coming. They need to offset weakness in exports with domestic consumption.
And I guess the fear, if I had to speculate, and I'm going to speculate, is that a lot of companies in China make their living by making stuff there. They sell it to us. Tariffs get put on. China, they sell less to us, thus you bring down earnings, thus you bring down the market. How much of those types of export-heavy companies are in the KWEB?
I mean,
versus domestic? Zero.
And
so the KWEB is all domestic China.
It's domestic China.
The tariffs won't hurt domestic China because they don't really, I hate to say it, folks, they don't really buy much of our stuff.
No.
It's about the GDP of the state of Nebraska. Total for China.
Oh, I mean, Washington State because of Boeing, Texas because of LNG and oil, and certainly the Midwest because of
energy is untariffed, by the way.
Correct. So I think there's an opportunity. I actually think there's an opportunity for an off-ramp. I think the push on the TikTok, another 75-day stay, as well as you have China's actually doing what President Trump said, which is raise domestic consumption, and they're actually spoke about that today. We just haven't seen the actual measures. And so I think that allows for this potential off-ramp, more dialogue. Maybe it's someone like Elon Musk, a trusted advisor who knows both sides. Maybe it's Larry Fink, Ray Dalio. Maybe it's Tim Cook, someone who knows both sides.
Tim was just there, and Ray Dalio, by the way, is a guest on Squawk Box tomorrow morning, 8 a.m. Eastern time. You see how I just threw that tease
very nicely done.
Brendan just threw that tease right in there. Brendan Ahern, K-Web, making some sense. Thank you very much.
All right, guys. I'll see you tomorrow. If anything crazy happens, I'm sure I'll be here if something goes on. But yeah, yesterday was too crazy. I couldn't like multitask through that shit. I was like, whoa, that's too much. This is too much. I gotta make some trades, and we'll see how it goes. But hopefully the volatility will die down because it's too crazy. Investor type people are not going to like this if it keeps moving up and down 3, 4, 5, 6%. All right. That's definitely not where we want to be. This is not where we want to be, but there's a lot of deals still that I want to look at. Oh yeah. Another thing too is like Boeing and Intel. They're still kind of like at the bottom of their ranges. I don't know. I was expecting a better deal, but it might not be coming. We'll see what happens. Okay, let's see. Hit the like and subscribe. All right. John has now 1.31k subs. Streamlabs.com/TheUrbanLandord. Donate there. You can also donate to Porsche at PayPal. Cash App, $PORSHAJAYE, or PayPal and Zelle at PORSHA@jghb.info. And you can email me at CrackCrack@jghb.info if you have questions. All right, I'll see ya.
Feel like I should go. Go. Feel like I should go. Feel like I should go. Feel like I should go. Like I should go. Like I should feel like I should feel like I should feel like I should. Like I should